Thank you, everyone, for joining us for another of our webinar series. For folks who are raising their hands, please jump in and you can use the chat interface to pop any questions you might have for our audience. The typical questions are typically, is this being recorded? Yes. Will we share this with you? Absolutely. And as always, we welcome your engagement throughout today's discussion. Um, Slightly going out of order, but a couple of things to mention. We are recording it, as I mentioned, and you can use the chat box at the bottom of your screen to submit any questions to our panelists as we go through today's conversation. Um, One more housekeeping item, and it's really around the CE credits. So this does count for an IACCP continuing education credit. Folks who have that designation, please forward this to the appropriate resources, and you can take the credit for it. All right. With us this wonderful afternoon, June the 2nd, I'm going to ask our panelists to introduce themselves, starting with Mr. Jay Horn.
Hi, everybody. My name is Jay Horn. I'm the Director of Supervision at Allworth Financial, an RIA, and also have a broker-dealer relationship as well through AW Securities.
Thank you, Michael. You're on mute.
I'm Michael Alexander. I'm a Principal Accounts Manager over at USA Financial Securities. And we have our own broker-dealer and TAMP platform that we use.
Thank you, Michael. Gary?
I'm Gary Baker, Chief Operating Officer at Canex Financial Exchanges. We provide data and analysis for guaranteed savings and guaranteed income products in both Canada and the US, and specifically annuities, where we provide a lot of modeling, benchmarks, and illustrations.
Thank you, Gary. Josh?
Hi, everyone. Josh Walbieser. I'm a partner in the law firm of Faegre, Drinker, Biddle, Reith. I'm the chair of the ERISA Financial Services subgroup, which is to say that I'm primarily aligned with the benefits and executive compensation group, in other words, the ERISA group, but do a lot of work with our investment groups and insurance groups as well. So good to see everyone. Thanks for having me.
Thank you, Josh. You're always welcome. Over to you, Tom.
Hi all, Tom Reeve. I lead our product team here at InvestorCom, innovating on kind of new product development, AI, as well as a lot of other initiatives here. So looking forward to the discussion today.
Thank you, Tom. Thank you for taking time. And for folks who haven't come across our programs or maybe in the past, my name is Parm Nasseri, and I'll be your host for today's conversation. InvestorCom, again, if you haven't come across us, is a leading software provider across North America, and our award-winning platform really focuses on taking some of these complexities around regulatory obligations and, as Tom said, bringing a flavor of intuition and simplicity to them. So we'd love to talk if there's interest. And with that said, let's move forward to our agenda. We're going to begin with the topic of the hour, which is the opportunity at hand in front of us. And it's this accumulation to income theme we keep hearing across our clients. And really, whether that's accumulation to income or annuity rollovers, we'll dive into the demographic trends and the opportunity at hand. Then we'll dig into the points of friction, the regulatory obligations, and learn from our panelists around best practices there. And then, tapping into everyone's collective wisdom here, how do you operationalize this? How do you balance the risks and the rewards? We'll do a deep dive there around best practices. And then, as always, folks, please jump in with any questions throughout today's discussion. Okay. All right, let's dive right in. And just to get us warmed up, I see people are still trickling in. I'm going to jump in and ask our first poll question. And it's really around why we've gathered today. So, Ankit, if I could ask for your help in popping our first poll question. And it's really around the annuity rollover strategy. Is this even on your radar? Is this something you're curious about? Is this something you're executing today? Or is this something that you're executing and see some room for improvement? Let's give it a 20-second. Excellent. I see the poll responses slow down, so let me end the poll and post the responses for everybody. Share results. And a bit of a surprise, at least from my perspective, it appears that there are a lot of folks in the room who are executing on this strategy. Having said that, there are also folks who are looking to find improvements or opportunity to grow. And then there are others in the room who could benefit from the extent of the conversation. So thank you all for participating in the polls. We'll have a few more specific questions throughout today's conversation. All right, let's dive right in. Gary, if I could point the mic your way and really set the table around. We know $1.3 trillion is slated to leave employer-sponsored plans. At the convergence angle, there is obviously demographic shifts as well. The interest rate environment also plays a part in this. Um, and obviously, the risk being longevity risk. As you look at the annuity product landscape, what do you believe is driving that surge of demand for annuity products?
Well, I think certainly it could be a number of things, but being product specific, the two primary needs that a client's looking for with regard to annuities, and actually, obviously, it's driven by an advisor conversation or some type of a planning process, is either protected income or protected growth. And the two I think the two historical products, actually three, if you will, until about 10 years ago, revolved around either an income annuity, which only represents about 5% of the sales in the market today, which is could be either deferred or immediate, um, or a fixed rate annuity, which is like a bank CD type of a product where you're looking for protected growth on a term basis. And at the end of the term, you're basically a rollover to a new product. And then ultimately a variable annuity, which similar to a variable life insurance contract, you're keeping what amounts to being mutual funds in an insurance construct. However, in the case of variable annuities, that the protection really revolved around tax deferrals, even for non-qualified assets. But the industry's done a really good job, I would say, over the last 10 years to really look at how to maximize the value and options for protected growth and income. And so a huge increase amongst the introduction of index linked products, the investment world's equivalent of that as a structured product, if you will. But what that does is gives you the protection, not only on the growth side, on the downside and maintaining the principal, but there is a cap or some type of a ceiling, if you will, so that the insurance company can provide that guarantee. On the income side, with a living benefit or a guaranteed withdrawal benefit on these index-linked products, you're actually seeing guaranteed results, if not even additional hypothetical results, outperforming what you could get not only from a variable annuity, but even for an income annuity. So I think the market's done a really good job of really fine-tuning that value proposition. Unfortunately, it's introduced a lot of complexities, but overall, the market since the pandemic has moved from a plateau of about 200 and $250 billion in retail sales per year to this past year. It's coming close to $500 billion. It was over $450 billion in annuity sales. So, and replacements or rollovers really account for half of that volume for annuities. So there's a lot of money coming in into those products, not only from IRAs or 401ks, but also for folks to roll over to a new guarantee from an existing annuity.
Thank you, Gary. The numbers are real. The trends are our friend, as they say. Michael, let me sort of look at this from a practitioner's perspective. Obviously, given the demographic tailwinds, the sustained growth in the rollover and annuity volumes market, how do you see, given your area of expertise, how has your practice been evolving over time?
Well, with ours, it's been a lot more complex products coming our way, a lot more. You see different RILAs, FIAs, all sorts of annuities, riders, and stuff like that that we have to account for when we're looking at the rollovers. We're seeing a lot of younger clientele come into our representatives in their 40s, their 50s, some and their 60s and stuff, and they're looking at retirement, 10 plus years on, and they're trying to plan for that income stream when they are retired. And again, because of the innovations that the industry has had in the products, especially like your income riders that have death benefits as well attached to them. You've got death benefits that pay out over a 5-year time that are the same level as the income rider. You've got RILAs that have buffers, they have triggers, they have all sorts of complexities to them. The biggest thing on that one is to make sure that we have something that can look at all aspects of those changes, compare those particular products, and not just get pigeonholed into one or two different products that we're used to selling. We got to be able to look at all these things, because the other thing that we see there too is brokerage accounts and third-party money managers as well that get thrown into that mix as part of their overall financial plan. And it's just becoming a much more complex landscape for our advisors to navigate as well as the firms.
I agree. I think between what Gary said around 401k rollovers and advice surrounding that, and then the complexities and the ever-evolving product suite of annuities, it's almost like it's an exponential formula of complexity. And Jay, I just wonder, I know obviously all worth well enough, but how has the rollover conversation evolved at your shop over the last 5 years?
Yeah, sure. A couple of things. We're more of fiduciary now, so we're on our RIA space. And one of the things is we're looking at variable annuities 5 years ago. Now people are looking at RILAs and FIAs. And we're also added a outside insurance desk to help us with that process. So that's a big thing. So just to give you an example, we have a captive firm, insurance company, and then we also are using one that can use multiple carriers to help us with that. And they're helping us with those conversations. What we're seeing is, the clients' income riders, we may be able to increase their payouts through that. So we're able to show that as one of the things that is big, and also looking to reduce the cost and also help manage the crediting strategies for them at Allworth as well. So
That's amazing. I mean, some of those strategies I typically see go over people's heads. They are complex, they are nuanced, but they define the outcome for the end investor, the end participant in this case. And I think that's where there is that value proposition. Gary, I think you touched on this a bit, but really looking at this from the advisor's lens, who perhaps haven't historically recommended annuities and maybe feared the complexities around this. What's a core argument for incorporating annuities into that rollover conversation in your view?
Yeah, I mean, again, there's multiple answers to that, but I think fundamentally, first of all, annuities aren't for everyone. I think it really falls along the risk spectrum. If you have a client that's risk averse, and they want some protection, then rather than whether again for accumulation or income, if you're looking for some type of guarantee, you're basically buying insurance. and I'm sure we'll eventually get into the fee conversation when you're evaluating different types of alternatives when you're rolling over into either an investment or an annuity. And there's a cost of that insurance, and that cost is either explicit in the form of fee. You'll definitely find that in a variable annuity, but it'll be most cases very implicit, especially with these newer FIA and RILA products. But it's something that if you're an advisor and you're looking to provide a solution for your client, and you're going to walk them through a planning process, and kind of set the stage on what their portfolio would look like, it would be prudent to consider some of these insurance products, if you will, to help support the portfolio, especially if your clients somewhat risk adverse. Certainly, some clients choose to take that risk, even on a longevity basis. But yes, you're giving up a little bit of control for that. But ultimately, it comes down to client retention. If you ever build that trust and put a portion of your portfolio in a safe place, that overall will help improve the plan in some regard, then the client is probably going to be more likely to come back to you. As you know, there's probably some research around when somebody's approaching their retirement age. That's a point in time where there's a lot of flight from one advisor to the other, and they're looking for somebody they can trust now for the next 20, 30 years. And a really great example of that firm we support is Fidelity. They're an asset manager. They probably the largest producer of annuities in the U.S. And they see that as a client retention play. Yeah, they're going to sell you a bunch of Fidelity funds at the end as well, but they're establishing that relationship and position that they can be trusted, and they're probably one of the top three producers of annuities in the U.S.
Gary, thank you. That's we keep hearing about that same strategy across our client base as well. Josh, I'm curious in your practice, what are you hearing from your client base around obviously the shifting demographics, the annuity rollover opportunity at hand?
Sure. Maybe I could maybe answer that two ways. I mean, let me start with advisor clients. Of course, the questions there are around how do we do this, and maybe two groups of questions. One is particularly from a rollover perspective, what are the strict requirements and limitations that apply under ERISA, including the prohibited transaction rules that apply to plan and IRA assets and the PT exemptions that we rely on. But maybe more interestingly and more fundamentally is how do we do the best interest analysis in this context? Because that's the kind of the common denominator that cuts across all the areas of regulation, whether you're talking about ERISA, whether you're talking about Reg BI as a broker dealer, whether you're talking about state law, the NAIC model rule, so on. So that's kind of the interest we're getting there, particularly in light of all the complexity of different annuity products. I think there's a lot of advisors out there that are comfortable in the rollover context, kind of doing the traditional apples to apples analysis, where it's a 401k plan with funds, an IRA with funds, and we're comparing the funds, the costs, and so on, and in sort of an objective sense. The annuities create new challenges. I would also say really quickly, from plan sponsor perspective, I think that there is a cognizance of the issue, which is, by the issue, I just mean the need to focus on the decumulation phase of retirement. There's an interest in helping. I see a lot of clients getting financial wellness programs, things like that. And I'm getting questions about things like in-plan lifetime income options. What I'm not seeing personally, I'd be interested if anyone has a different experience. What I'm not seeing is a lot of actual uptake of in-plan annuities, in-plan lifetime income options, which is to say that the traditional rollover to qualified annuity distribution channel is going to continue to be a very important part of the equation.
That's a fantastic insight, Josh. Thoughts, team? Gary, maybe? Are you seeing as much uptake of annuity solutions within the employer sponsor plans?
Yeah, I mean, we support that too, and in fact, there's been an evolution of that where they're really applying in many cases, even an index annuity construct within as an allocation option of the target date fund. But there's still a lot of headwind around adoption on that. There's been work on fiduciary, practices with regard to, how a plan advisor would work with the investment committee or the, the executive team at the business on how to set up the plan. But it's been a holy grail for quite some time. I think there's just continuous evolution around that. But I think at the end of the day, with where folks are defaulted to, they're going to look, to roll back into their own individual configured plan when they reach retirement. Somebody, a mentor of mine way back early in my career said, at some point, people want their money back. So, and in their own individual accounts. And I think that's, as was just mentioned, I think that would still be a dominant process.
I'm sure everybody in this room has heard that a few times. I want my money back. Um, let's before we dive into the regulatory section, first of all, folks, jump in. I see some questions popping into our chat box. Thank you. More questions, the merrier. And then second thing is let's jump into our second poll question for this afternoon. We want to know your thoughts. How would you describe your firm's current approach to annuity and rollover recommendations? As Josh said, there are probably three layers of regulatory expectations between what the Department of Labor requires, the SEC's best interest standards and requirements, as well as the state level NAIC. I keep reminding myself to somehow bring some Jeopardy music for these, but you might need to update that song request. I see the responses, and it's pretty interesting. Let's give it a few more clicks. All right, sharing the results. There are folks who have a fairly manual process, the Excel spreadsheet and frustrations. Others have a mix of manual and technology, and power to you for embarking on that tech-enabled journey. And then there are others who have a high degree of confidence, and hopefully our clients in the room who have embarked on a purpose-built technology. The best part is the last outcome. I mean, the last option. Nobody has clicked on. We don't have a defined process for this, so that's a ray of sunshine through all this layers of complexity. I'll stop sharing and let's sort of double click and zoom into our regulatory obligations around this. Um, Josh, you touched on this a bit. I mean, there are layers upon layers. Where can one actually get started as it relates to sort of 401k to IRA recommendations today?
Sure. And let me start with the area of regulation that I think, in a sense, is the hardest to pin down, which has been the oscillating guidance from DOL over the years, largely due to litigation and where we are today. So where we are today is that we're back to the five-part test for fiduciary advice. It's the test that's been on the books since 1975. In particular, the requirement that you have to give advice on a regular basis in order to have it be fiduciary in nature. And so, but where we're at is in terms of determining, are we a fiduciary or not? And to be clear, I'm talking about fiduciary under DOL rules here, not SEC rules or something like that. When we're talking about rollover recommendations, it is possible in some cases for certain advisors, particularly insurance agents and brokers, to make rollover recommendations that in and of themselves are not necessarily fiduciary in nature. And where we usually see this is where the agent has no pre-existing fiduciary relationship with the plan or the individual. But in other circumstances, you will be a fiduciary with respect to even a one-time or infrequent recommendation or rollover transaction. So if you are a fiduciary, then you need to be using a prohibited transaction exemption for any what they call conflicted compensation. And the primary one for rollovers is prohibited transaction exemption 2020-02. And PTE 2020-02, it's not necessarily the only one that can be used in connection with rollovers, but it's certainly the broadest and the most flexible. And again, this is just a very brief summary of ERISA DOL guidance. You have to keep in mind that SEC rules for broker dealers and advisors, including Reg BI for broker dealers, as well as state rules following the NAIC model, are all going to come into play here.
Lots of fun. Thank you, Josh. Thank you for simplifying it. Tom, lots of names here. Tom, you've been working with our clients on similar threads. Obviously, complexities around rollovers, complexities around annuity recommendations. Any insights to share with our audience?
Yeah, I think there's a few things I've heard and sort of learned over the course of speaking with our clients and really trying to think about what does the best, solution to help firms sort of tackle this massive growth opportunity. Um, the first thing I think, which is probably obvious, but really makes a big impact with some of our clients who have implemented this, is one sort of consistent framework for actually documenting these recommendations and what is in these recommendations. When I think about sort of, a lot of times moving from a manual process to a technology-enabled process, it's really about how are we, putting the right information in front of the advisor, allowing them to provide us with the right information, and really combining, their inputs and market data to help, show them what best interest and what, good suitability analysis looks like. Specific to annuities, I think there's two really core things. I think one is the ability to compare different products across product types towards a common or a primary goal. I think, Gary mentioned there's two very common goals, which are protected growth and protected income. And so, how do we enable firms to, you know, evaluate products against that goal? And then the last piece, just quickly, is really, what we view our technology as doing is documenting sort of the reasoning why a product might be in someone's best interest and putting that in the kind of rationale or disclosure instead of just a conclusion that was drawn to or details about the product that don't actually explain why it's right for that specific individual. So I think consistency, outcome-based analysis and really documenting the reasoning, not just the conclusion, are some of the core things we've seen.
Thank you, Tom. And some of the data points you see, folks, in front of you are a result of a case study we did across our client base around, well, what are we seeing around rollovers into annuities? And the numbers are quite honestly quite significant. And this is a market opportunity that perhaps given demographics, market trends, product innovation, there's a lot of regulatory scrutiny around. And speaking of which, Josh, maybe looking at this from a supervision perspective, I'm sure this question around, hey, can you prove it? What have you documented? That's probably front and center for across a lot of your clients. In your view, what are you helping your clients understand as they're looking at compliance solutions and this supervision question that continues to come up?
Sure, absolutely. In whatever solution is going to be used, I think that this is something that Tom touched on, and I think it bears reiterating, is it needs to be something that can deal with what you might call the quantitative aspects of a lot of competing products with a lot of varying and complex features, but also the more qualitative aspects. Because again, the common denominator that cuts across ERISA, Reg BI, NAIC, so on and so forth, is to act in the client's best interests, not to subordinate the client's interests to the firm or the advisor's own. And part of that is to understand that this is a personal recommendation. When you're talking about annuities, we're talking about a balancing of, let's say, on one hand, liquidity needs versus the risk and fear of running out of money in retirement. Risk tolerance, so on and so forth. So you need to have a system that can deal with both of those on a day-to-day basis. Now, when it comes to supervision and also record keeping, I would say you'd want to have a system that is capable of producing reports, running queries, that is technologically savvy enough to allow someone in a supervisory role to sort of spot trends and oversee and carry out their supervisory responsibilities on an ongoing basis, where if there's some trend that seems to be concerning, say about a particular advisor, you can spot that in real time. And I would say third and finally, record keeping. You're going to want to have something with ironclad data security, both from a cybersecurity perspective, but also because you will end up having to print these reports, get this data, and show it to whether it's a regulator or otherwise at some point. So you need to make sure you're really ironclad on that aspect.
Thanks, Josh. That's sound advice, if I could call it that, with the right guardrails. Jay, you speaking of supervision, I'm sure you've seen many exam requests across FINRA and the SEC as it relates to rollovers. Perhaps from your experience, what are some common findings or areas that firms can be exposed on?
Well, kind of speaking to what Josh is talking about, having a quantitative process, being able to document, be able to train your advisors on new products, regularly check your policies and procedures, and also look to, partner with other, like your compliance consultant, or look at other softwares to help you with building out your policies and procedures a little bit better. So that's the one thing that here at our firm that we're looking to do there. So, and retaining the documents in, our client files. So, so I hope that helps.
Absolutely. There's actually Josh's colleague, I'll give him shout out for this because he's invented a term that lives front and center in my head. David Porteous often says, what you don't want to do is conduct regulatory archaeology after the fact. And that's when it gets way more expensive, way more costly to try to, bring variables together of, hey, why did Parm recommend a rollover to Josh 4 years ago? And what was the rationale? How was this in Josh's best interest 4 years ago? And let's just, start bringing facts together from, chat to email to other correspondence avenues. So I'm sure, Michael, you hear about this all the time as you help on the practitioner front. Um, to you, perhaps, given your 20 plus years of experience or what you're doing at USA Financial, what does demonstrating best interest look like?
Well, for us on the annuity front, we want our representatives to at least compare to two other products besides the one that they're selling. The more products they can compare it against, the better. And again, having a systematic process of doing that, a system that can go in there and analyze those costs is key. Something that can rank those particular products. And then, as Jay and Josh had mentioned, being able to run reports off of that later on to be able to compare that, make sure that they're looking for the best interest of the client. The one thing that's really nice about the reports is that, like, we use peer compare, and it shows the cost of the product, but allows for additional notes to be put into that particular document as well. So for those things that go above and beyond cost, because cost is just one part of it, we can document the specific situations for each individual client, what they're running across, what their goal is, so that we can work with the representative and have those things covered. We also utilize a rollover analyzer program that allows us to look at the programs that they're coming from, or the investment accounts that they're coming from, especially their 401ks. Looking at the large companies, mid-sized companies, small companies, getting their exact costs. That's key to being able to compare where they're coming from and going into. So, yeah, and the thing is too is that you got to have it customizable to your rep base. You have to be able to look at it and say, okay, this is the common verbiage that we're using for our firm. What kind of changes? There's constantly regulatory changes in the industry. We need to be able to adapt those reports that we run from that, and having something that can do that is key to that. again, the rollover analyzer report that we use and the peer compare report that we use allow us to keep up with those constant changes in this particular industry and make sure that we're meeting the best interest standard that our reps are coming across.
You're muted here, I think.
I was singing your praise, Michael, for dropping our product names. Thank you. That was very much appreciated. Um, you touched on one thing, which is around, the transition that a lot of folks go through as they're thinking about documenting this. And Tom, maybe I can kind of pick on you for a bit, just given how much work you've done with our clients around. Majority of them come to us, they have a manual process. Jay, maybe you touched on this from having a policies and procedures, a manual PDF, fillable PDF form, and they're looking to transition to a tech-enabled solution. How do you see, Tom, our solutions being able to generate value for our clients there?
Yeah, great question. I think, the most obvious point and the lowest hanging fruit is really kind of reducing any risk associated with advisors or users really entering incorrect information around the market data of a current product. Um, these products change on a very frequent basis, and Gary will tell you that. And so, technology platforms that re-ingest and ensure their data is up to date really reduce some of the risk around both either incorrect data entry or stale data entry. And I think those are two things that, really without any malpractice or any intent can lead to regulatory issues because of data being recorded incorrectly. Um, I think one of the core things about integrating data into a technology platform, into a process which is not available in a manual process, specific to annuities, is around some of the eligibility criteria. These products really change depending how much the initial premium you're planning to invest is, where you are in terms of your state, whether it's a single or joint contract. These sort of different levers of annuity contracts and costs and pricing, it's not fun to go through manually. I wouldn't wish that on my worst enemy. And so a technology-enabled solution really decreases the time it takes to understand and really evaluate these products for your end investor. And so I think with annuities more than most, it's extremely important to leverage technology if you can.
Awesome points. Thank you, Tom. Folks, it's 1:39. I'm always shocked at how quickly time goes when we're having a good conversation. Let's jump into poll question number uh, 3. So, what's your firm's biggest regulatory concern around annuity rollover recommendations? Interesting. Let's give this a few seconds. One more. We go. 30 responses. Let me just share the results. As folks can see, good thing we touched on it. Michael, Jay, everybody touched on proving best interest and reasonably available alternatives. Foundationally continues to be, what is it, 5, 6 years now into the Reg BI journey, continues to be a bit of a thorn for folks and perhaps something that technology can help solve. And then obviously supervisory as well as compliance when with ERISA requirements is a concern. I think you saw the prompt in your chat box, folks. If you've got a question for our panelists, please feel free to jump in. Now, with the regulatory backdrop behind us, well, I'm sure we'll come back to two through questions that people will have. Let's talk a little bit about seizing the opportunity. And, we talked a little bit around demographic trends. I believe there was a few slides up around, the number that speaks the loudest is 4.1 million Americans turning 65. through 2027. That's a big number. That's a big number, and a lot of life savings that are going to be moving potentially from 401k balances. So, um, Tom, you have some visibility across our clients to evaluate and compare annuity products. What does this best interest or reasonably available analysis look like in practice, in your perspective?
Yeah, I think this is another category where um, it really differs for annuities and more complex products than your kind of traditional mutual fund or ETF securities. I think, if you were to stand up a practice of comparing reasonably available alternatives for annuities, your first instinct would be, I plan on selling, this VA. Let me look at two other VAs that might be reasonably available alternatives that I can sell and run my evaluation that way. Um, I think what Gary spoke to about the innovation in this, with respect to different product types in this world, has really made it increasingly and incredibly important to compare across product types. And I think that makes your reasonably available alternatives analysis a lot stronger. And I think the regulators would largely agree. Now, saying that is a little more simple than doing that. And so to do that, I think you really need to anchor to outcomes. Again, I feel like I've said, the primary goal is a very important piece of this puzzle, and I really think it is. But it also allows us to really key in on what that end investor is looking for and rank and evaluate products and alternatives on that spectrum. Be it accumulation, be it guaranteed lifetime income, be it, the value or potential value of a death benefit. I think using those outcomes to help analyze products across reasonably available alternatives and across different product types is super, super powerful. Um, I think the last piece to this is just with this complexity across different product types, it's really important that your practice includes, be it either technology or through different education paths, the ability to break down these complex products and riders into more consumable and more, frankly, understandable pieces to ensure the advisor and the investor know the product that they're recommending and that they might be purchasing because these products change often and there's a lot of complexities to them, and making sure both parties are educated on what each product can do for the investor is super important.
Really good points, Tom. Thank you. Um, this is a complex, and obviously from a magnitude of advice perspective, um, we're talking about folks' retirement savings, everything that's been bottled up in the 401k for, folks' career. And so there is complexities and there are sensitivities around this. And Josh, when it comes to, if you were to kind of put your magic wand on, what's the no regret compliance investment in your respective view that our, audience can embark on?
Sure. And, just for those of us who've been working in the industry long enough, you'll recall that we had the Obama era fiduciary rule. We had, PTE 2020-02, which is still live and was kind of the replacement for the best, what they call the best interest contract exemption in the Obama era rule. And then we had the 2024 DOL rule that was struck down in litigation, leaving us with the current, the investment advice definition we've had forever in the current version of 2020-02. And that's just on the DOL side. Reg BI is relatively new. We're getting, it seems like we're constantly getting new and evolving guidance from SEC. NAIC is always there and is always in the playbook. So what I would say, Barm, is in terms of the no regret compliance investment, I think what we mean there is that it's becoming increasingly difficult, almost impossible to keep navigating the contours of these different laws and trying to avoid exposure to them. What the trend that I see people saying is, look, we can't keep doing this. We can't every 2-3 years, the change of administration, undo our systems, retrain our advisors. What we need to do is steer into the skid and sort of embrace the common denominator across all these areas of regulation, which is, again, the best interest practice and the best interest process. So, and I could boil it down. I'd say there's four general categories that I think are common to PTE 2020-02, Reg BI, and the NAIC model rule, which are one, best interest, client's best interest, no subordination of the client's interests, the reasonable compensation, honest, fair, full disclosure of the commissions, the conflicts of interest, the whether you're acting in a fiduciary role or not, dealing with and mitigating conflicts of interest as a firm and supervision, and ongoing compliance, doing our stress testing, our reporting, and being ready to respond when we get inquiries from regulators. So those four areas are pretty much common to all of these. And if you really steer into it and you would develop a process that embraces all these, you're not going to find yourself making huge changes to your systems and retraining your associates every couple of years, every time the administration changes and so on. So
That's so well said. There's some of these core principles that you've identified, acting in your client's best interest, not subordinating your client's best interest, and um, those will pass the test of time, to your point, Josh, and you said it way better than I did. Thank you. Jay, as you think about what Josh said, obviously the layers upon layers of regulatory expectation, and obviously you've got a large advisor-based population. How do you put these things? How do you operationalize these requirements in practice?
Well, we're definitely using a standardized process. And, especially if you're moving an IRA to IRA, annuity to annuity, we're going to run it through our tool to help document that. But on top of that, we're also looking at these annuities with help from our outside insurance desk to see if it makes sense to move, especially based on what the client's goals are. The biggest thing is if they're looking for growth, maybe an annuity doesn't make sense. If they're looking for income, we're going to explore another IRA annuity there. So those are the biggest things that we do. And, we have an insurance desk at Allworth that will filter out and help them design if we should move on to the outside insurance desk there. So.
Jay, thank you for sharing that insight. Just one more question on the how do we operationalize this strategy of annuity rollovers? And Michael, maybe I can come to you on the practitioner level. Firms that are just beginning to think about this strategy, and as you saw by the poll results, there are some in the audience. Where do you start? What's the single most important thing to get right in your respective view?
The single most important thing is to have a program, not just pen and paper, having something that's going to be able to track all this stuff for you. Something that's going to be able to analyze a rollover from one qualified plan to another. That's a big one. Making sure that the answers on said report are standardized to an extent that it's easy to understand why they're making that particular move. It's easy for the client to understand. It's easy for the rep to understand. It's easy for the principal reviewer to understand what's being done for that particular client. And then also to be able to analyze those trends by pulling those reports for that particular representative. And then a program that would be able to look at the various different annuities, look at it across from different product types, looking at your RILAs, your FIAs, your VAs. There's a lot of differences in those particular products. And there's a lot of things because clients can get concerned about annuities and all their different functions. And they may think that an annuity is like it was 30, 40 years ago, where you just had the ability to annuitize the income. And once you started the income, you can't stop it. We need to be able to look at that stuff. And then also too, that comparison program should be able to open up the representative's field of view to other products. So maybe consider other things that they hadn't considered before. Something that could be more in the best interest of those particular clients that they're dealing with. And it just helps the reviewers when we get that stuff in to be able to analyze it and be able to understand exactly what our representatives are doing.
Fantastic, Michael. Thank you for sharing that. I see we're at 1:51, and I promised the last 10, 15 minutes to address any audience questions. I saw a few trickle in. Let me sort of just put this on the radar for folks as we jump into our lightning Q&A round. Today's discussion summary and obviously a best interest rollover asset are going to be available for folks to download once you exit the Zoom. You can click your preferences as to what you'd like to see, and we'll put that in front of you. With that said, let me jump into our questions that have trickled in throughout today's conversation. The first one's a doozy. It's a more of a annuity expertise, so I'll just lay it up, and whoever wants to jump in. And so the question starts with, how do you compare crediting strategies? Everyone's favorite topic of the day, strategy rates, when the strategies vary for the client. For example, comparing a 3-year to a 6-year, or point to point versus tiered par. Any thoughts on this?
Very difficult when comparing those, quite honestly. You have to pull a lot of information from various sources. We wind up pulling data from the insurance carriers, website to figure out what exactly is being calculated. I mean, it becomes very difficult because even if you're looking at a 3-year to a 3-year, there can be calculation differences behind the scenes. So that's one that when we're looking at it strictly because of rates, it may require extra communication with the representative to compare that stuff. What becomes a little bit easier is if we're looking at features of that particular product, how the like one has a buffer versus one has a trigger on there. If you're talking about RILAs, it's kind of a case by case basis. I can't say that there's a one size fits all answer to that particular one. Rates are definitely not my personal favorite to have to compare. I much prefer if we can advise our representatives, look at the features of that particular product, not just the crediting strategies. What other features does it have to offer that particular client?
Thank you, Michael.
I mean, I think it also depends upon what the investment conviction is of the client. I mean, if you're looking at crediting strategies in particular, I almost view it as a kind of like a Reese's cup. You're combining a market index, the chocolate, with the peanut butter, which is a crediting calculation, and it's your view of how you think that market is going to progress over 3 or 6 years, how volatile it is versus maybe there's some management of that volatility within the index itself, and then the calculation that goes with it. One of the things we've done is actually provide outcomes for those around yields and whether or not you want to put a good market scenario through that crediting strategy or some other type of capital market assumption. But to Michael's point, you kind of have to look at maybe more of the qualitative aspects, and that's just one piece of it. So it really depends upon how you're going to configure the other benefits around that crediting strategy as well. One thing just to think about is that if you're solving for income relative to the engine of a crediting strategy underneath it, just remember that there's there's a 9 blocks for investment styles. There's 7 different types of living withdrawal benefit styles on how income could play out over the lifetime. There's some that start high and end up lower, and there's some that may increase, but in our research we found that there's different styles around that. So I think it's a qualitative aspect around going from category to category or different flavors of products, but then you can kind of fine tune that with some qualitative or quantitative aspect.
One other thing I'd just like to add to it, just kind of building off the whole conversation, is illustrations are another thing that we utilize quite extensively. It helps us quantify what the client is looking for, what the investment strategies, what they illustrated as far as returns for the client. So that could be another thing that helps out with the, whether you're looking at a 3 year or 6 year or 1 year point to point on these things. It helps a ton.
Absolutely. I think there's one more variable in this, and maybe I can raise this that came up across our clients before the webinar. And it's around given the best interest obligations, given that you need to have a reasonable basis for the recommendation, consider available alternatives. What role do you all feel does the concept of a product shelf play in the mix there? Because, for example, if you don't have an entire universe to compare to versus select curated list of products, there is that element of what is available on your product shelf. So, any thoughts on that?
Um, I mean, it's good to be able to compare to an entire universe of products. Um, the one thing that we have to be careful of as part of a broker dealer, we got to make sure that whatever the reps are selling, they're licensed to do it. They have their agreement in place. So, you got to have those conversations with the representatives. This shows the entire universe of products, but it's like, here's our products that we have. For our BD, we have a lot of different agreements with different annuity carriers. So typically we're going to have something that is available. So that seeing the whole universe isn't such a big deal like for us. But it's definitely something to be very, very careful of with that. But again, the more comparisons that you have, I think it allows you to be able to better solve the client's issues. And if there is something that maybe the broker dealer doesn't have an agreement with, maybe it's something that the BD can look into. If they can add it, great. If they can't, they'll come back from their compliance department and tell you exactly why it can't be added. But the comparison there, I think it's a very valuable thing to have a whole universe of products so you can see what the rest of the market is doing. Because otherwise, your vision is just you got the blinders on.
Yeah, yeah, absolutely. Absolutely. That does come up quite a lot. And and the length of documentation when you have to do things manually becomes that much more painful, if I could say it that way.
Yeah.
1:58 on the dot. Before we know it, it's going to be the hour. Thank you everyone for jumping in. One more quick question. Josh, as when it comes to sort of your practice area, what's the one regulatory action every firm should take right now, regardless of size and complexity in your view?
Sure. In my particular area, Parma, I would say that you really do need to do a careful deep dive about when and whether you're acting as a fiduciary. And then from there, make sure that you are checking all the boxes for whatever prohibited transaction exemption you're going to be relying on. Again, it's true that a lot of one-time recommendations now are not fiduciary in nature, but that is not always the case. It's often not the case. So don't make any assumptions and err on the side of caution.
Folks, you heard it here first from Josh. Thank you for spending your Tuesday afternoon with us, and we'll share a recording of today's conversation along with snippets with everyone who's attended. Thank you very much for your time.